Welcome to this video on interest rates in 2026, what to expect. Even if peace deals are reached, central banks are likely to continue raising rates. We will look at who stands to gain the most in this economy. The big picture suggests that peace doesn't mean lower rates. HSBC economists indicate that even a US-Iran peace deal will not stop the global cost of borrowing money from continuing to rise. Several countries and regions are forecasted to hike rates in 2026. Australia and Norway are expected to hike rates in May. The ECB and BOE are expected to hike in June or July. The U.S. Federal Reserve will likely trigger more tightening worldwide, and India and Indonesia are forecasted for hikes in the second half of 2026. There are three main reasons for these hikes: ongoing supply chain issues, stubborn inflation that is not coming down as fast as hoped, and central banks prioritizing bank credibility in controlling inflation. Commercial banks are set to be winners. Higher interest rates allow banks to charge more for loans while paying little on savings accounts. This difference increases their net interest margin, boosting profits. The Indian market is a key focus, with rate hikes expected in the second half of 2026. This favors major Indian lenders with strong domestic deposits, such as SBI, HDFC Bank, and ICICI Bank. Insurance companies are also winners. They invest premiums in safe assets, like government bonds. When interest rates rise, the returns on these bonds increase, boosting the insurance company's bottom line without increasing their risks. Cash-rich big tech companies, like Microsoft and Apple, benefit too. Low debt protects them from high rates. Their massive cash reserves earn huge interest income. Furthermore, smaller, debt-reliant competitors find it harder to grow, enhancing the market dominance of these giants. The forecast shows the Philippines with a high priority for rate hikes, while India and Indonesia are expected to hike in the second half. The U.S. Federal Reserve, with its influencer role, will likely cause emerging markets like India and Indonesia to tighten policy even further if the Fed hikes rates. Companies set to gain include HSBC in global banking, SBI and HDFC Bank in Indian banking, Apple and Microsoft in big tech, and LIC and HDFC Life in the insurance sector. A looming risk is the endurance of supply chain problems, particularly in the Strait of Hormuz. If this remains risky, energy prices will stay high, forcing central banks to keep rates up to fight inflation. This indicates that geopolitical peace doesn't guarantee immediate economic ease. Higher interest rates are on the way. However, for prepared companies and investors, this period can lead to strong growth and better returns.